We're trying to determine the probability that we're actually going to have a recession. We spoke about this not too long ago. We're looking at the major economic numbers, and on the surface lately, they actually don't look that bad. It looks like the economy is improving, at least from this measure. But we're going to show you other measures. Starting off with the GDP that was released last week at a level of 3.0%. So, according to the gross domestic product, the latest revision, the economy looks like it's strengthening. It's strong to an extent, at least according to the GDP. What we're going to show you is that the economy is not just the GDP. Here's inflation. It's coming down. Personal consumption expenditure on a year over year basis, 2.2%. It's the lowest low we've seen in quite a long time. Certainly is returning to the Fed's 2% targets. On the core PCE, excluding food and energy, it's also declining, maybe not as quickly though, 2.7%. Why is this? It's because fuel prices are really so cheap that when we exclude food and fuel, inflation is not necessarily coming down as much, but we can see it's steady. It's between 2.6, 2.7% for about 4 months in a row now. The Case-Shiller Home Price Index is rising. That's a good thing. We're at a 326 level right now. That's the highest high we've seen in quite a long time. And if you're curious which markets within Case-Shiller seem to be the strongest, that would be the big cities: New York, Las Vegas, Chicago, San Diego, Los Angeles, etc. Now let's talk about new home sales, because the new home sales paints quite the different picture, and it seems to contradict the rosy outlook from the PCE and GDP numbers. We're going to show you declining inventory. The amount of homes out there is declining. Well, that could be a good thing. The sales numbers are also increasing, but the prices are falling. And the combination of these two, that doesn't look so good. First off, new homes for sale. This is the monthly supply. If we were to sell all the new homes out there, how many months at current pace would it take? The answer, 7.8 months. We'd like to see the number higher, certainly to give buyers a better selection. But the monthly supply declining is showing us that inventory is being pulled off the market. That's good. Maybe not necessarily. What we're going to show you in just a moment is that maybe the monthly supply is declining because it's not being replenished. There aren't more people saying, hey, here's my house for sale. New one family homes sold. This is the volume. We're at a level of 716,000. That's good. That seems to be rising steadily over time. But we can see the new one family homes sold on a year over year basis. That's also rising. That's 9.8%. So this looks good at the surface, right? Not necessarily. The average sales price is declining. You see, more homes are being sold. And remember, the monthly supply is declining. So more homes being sold. Those homes are not being replenished or refreshed. The supply is not being refreshed. So there aren't new sellers out there. And even though there aren't new sellers out there, the sales price is declining. The sales price is now at 492,700. That's the lowest low in quite a while. So even though, despite the fact that the inventory is shrinking, so is the average sales price. It seems counterintuitive. But take a look here. This is the average sales price on a year over year basis. We're down 7.1% from this time last year. So despite the declining inventory, there are more homes being sold, but are they being sold because there's new buyers out there, because the buyers have deeper pockets? Rather, there's more sellers that are coming to the markets, but not as many as needed to keep the supply up. Here are some signs of trouble for the housing market. This is from CNN. A new report illustrates just how stuck the housing market is. Just 2.5% of homes in the U.S. changed hands this year in the first 8 months. It's the lowest turnover rate in at least 30 years. That's from Redfin, by the way. Furthermore, they say it's a toxic combination of record high home prices and elevated mortgage rates. A rate cut by the Federal Reserve this month has fueled hopes that interest rate sensitive housing market will soon experience a fresh jolt. Well, let's think about that for a second. Is that right? They're saying that because the Federal Reserve cut rates, hopefully soon we're going to see a jolt, a refreshment to the housing market. Well, that would require people to enter or to leave the lock-in effect. For those of us that bought homes with low interest rates, we don't want to sell our house now because we sell a house, we buy something new, we'll end up with a house with new higher interest rates. So is a lock-in effect ending? Well, in green, we see here, and this goes back to 1994, the new home sales. This is the volume, the number of homes that are sold. In purple, that's the 30-year mortgage. Now, zoom in. Let's just consider the period of time from 2008 through present day. That's the period of very low interest rates when a lot of us bought homes. Take a look at the white line. That's at 6%, which is roughly right around where 30-year mortgages are right now. Notice that the purple line was below 6% almost the entire time until just about a year and a half, 2 years ago. That is the lock-in effect. This is the best way to demonstrate the lock-in effect, is that all of us that bought homes most likely bought homes at an interest rate lower than where we are now. So in order for those homeowners to be encouraged to sell their house, we need to see this purple line go back below the 6% level, which is more or less where it is now, but back down to the average. What is the average interest rates or the mortgage rate that most people were able to buy a house in the past 15 years or so? Well, we took a look at the data. This is 2008 through present. And notice most individuals bought homes with a mortgage rate of 4.5% and below, with an especially high amount of those purchases with 3.5% mortgage rates and even below that. So remember, again, we're at 6% mortgage rates right now, but the average home out there has a mortgage with around 3.5% mortgage rates. That is a lock-in effect. So just because a mortgage rate comes from 7 to 6%, even if it dips down to 5%, that's still not approaching the area most of us owned homes. By the way, we put together an extensive look at the data, and we'll throw a link in here as well, in case you're curious to hear about this some more. Now, back to our project. When do you predict the U.S. will fall into recession? We've been looking at this data over the past month or so. We've been asking all of you, thank you everyone to voting on our poll as well. We've refreshed the poll. It's brand new on our YouTube channel. On August 8th, we asked you, what is the probability that we'll enter recession on the U.S. elections? On the left-hand side, 35% of you said during U.S. elections. On August 17th, that rose to 37%. On August 30th, now 46%. It'll be curious to see nearly a month later how many believe now it will be U.S. elections. Or will it be the first quarter of 2025, the second quarter or later of 2025, or perhaps we'll have a soft landing? 23% of you said on August 8th that we're going to have a soft landing. The probability of a soft landing declined to 12 and now 15%. So please vote on our poll. It's on our YouTube channel, and we'll be happy to post our results as well to see how that has changed over time. We hope this has been helpful. We look forward to seeing you back soon.